In our previous session, we were able to talk about the accounting equation. And in this accounting equation, we were able to establish that assets are equal to liabilities plus owner's equity. Those are two sides of this equation. One of the side is showing the resources that are in the business, and the other side is showing the claims against the resources in the business. And of course, the resources that are in the business are the assets, and the claims on these resources that are in the business are in form of owner's equity or liabilities. We discussed this in more detail in our previous session. Now, when it comes to the accounting equation, this accounting equation is expressed in a certain financial statement. This financial statement is what is called the statement of financial position, or sometimes it is called the balance sheet. The statement of financial position serves to show the position of a business at a particular point in time. In other words, it serves to show how the business stands in as regards to the assets it has in relation to the claims against those assets. So if we were looking at the accounting equation, and we know that the accounting equation has the side of the assets and the side of the liabilities and owner's equity, that is exactly how it's going to be even with the balance sheet. The balance sheet has two sides. We have the side of the assets and the side that shows the liabilities and the owner's equity. The reason as to why it is called a balance sheet is because it has to balance. It always has to balance. In other words, the resources that are in the business are supposed to be equal to the claims against those resources in the business. So in today's lecture, I only get to introduce to you the balance sheet. We shall go over the basics of the balance sheet, and as our knowledge in accounting continues to increase, we shall get into more details on how the format of the balance sheet is paying attention to the intricate details. My name is Arnold Rwangakuramya, and this is Kisembo Academy. For starters, this is how a balance sheet looks like. It has a section up called the heading. The heading entails the name of the company. The name of the document is the balance sheet, or call it the statement of financial position. And then the date at which it is recorded. Now, again, I reiterate, a balance sheet is a financial statement that shows the position of a business at a specific point in time. That is why the heading is always written as at, because it is at a particular point in time. What you're seeing on your screen is the T format of a balance sheet, with one side showing assets and the other side showing liabilities and owner's equity. As our knowledge in accounting continues to increase, our balance sheet shall get more and more detailed, showing details like current assets, current liabilities, long-term liabilities, fixed assets, and so on. What you saw on your screen was the format in the T version, the T format of a balance sheet. However, the balance sheet can also be presented in a columnar format, like you're seeing on your screen. However, these are things that we shall explore later on. The purpose of this particular session is to just introduce the balance sheet and just to show how transactions affect the balance sheet. For those of you that have already been watching the previous sessions, you will notice that the way we are handling the transactions in the balance sheet and how things are playing out is not different from how we were doing it when we were dealing with the accounting equation. Because anyway, it is the accounting equation that forms the bulk of the balance sheet. Without wasting any more time, let's go over some transactions that will give us a picture on what a balance sheet looks like. So that's how a balance sheet basically looks like. Let's look at this transaction. It says that Kisembo started business and deposited £60,000 into the bank account, specially opened for the business. Just like the way we were dealing with the accounting equation, even with the balance sheet, we are going to have to do the same stuff. We are going to look at a transaction. We are supposed to identify which items were affected in that transaction, and then thereafter we either increase them or decrease them, and then we will fill them in our balance sheet. So Kisembo started business and deposited 60,000 into the bank account, specially opened for the business. So it means the two accounts here that were affected, we have cash at bank, because this 60,000 was deposited into the bank. So we have cash at bank. Cash at bank was affected, and also capital. So what is going to happen here is that we are going to, cash at bank is going to increase by 60,000, and also capital increases by 60,000. So now this is our balance sheet. It's important that our balance sheet is first has the title of the entity. Then the next line talks about the document, the financial statement we're talking about. In this case, it's the statement of financial position, or you can say it's simply balance sheet. Then, of course, a balance sheet always shows the position of a business as at a specific date in time. And of course, the third line shows the date as at which period of time. A statement of financial position shows us the status of affairs as at a specific date. And of course, we are looking at this as at 1st January. So this will be our side for the assets. This side shall represent liabilities and owner's equity. And so in this case, cash assets, we have cash at bank. The cash at bank increased by 60,000. And then on the side of the liabilities, we have owner's equity, which is capital. In this case, capital also increased by 60,000. Of course, this is in pounds. This is also in pounds. So our balance sheet here has balanced. So that is our first transaction. Let's go into the second transaction. In our second transaction, there is purchase of an asset by check. So what are the two items affected here? The question says that on 3rd January, Kisembo buys a small shop for £32,000, paying by check. So if it's paying by check, it means the cash in bank was affected. Cash at bank is going to reduce. And then what happens to the other item that is affected? It increases, and in this case, it is the shop. So we have an asset, shop, and this asset, shop, is going to increase. So we have a new asset in the business, and then cash at bank is going to reduce because we use the cash. So we ask ourselves, in our previous write-up, of course, now when we have the title of the name of the company or the entity, which is Kisembo Limited, statement of financial position, or call it balance sheet, as at 3rd January 2020. We say as at 3rd January because this transaction took place on 3rd January. So our balance sheet is representing the position of the business on 3rd January. So this side we have assets. In our previous transaction, we were able to see that our cash at bank was 60,000. So if our cash at bank was 60,000, and now on the second transaction, 32,000 of this cash was used to buy a shop, it means that our cash at bank reduced. So our cash at bank here is no longer 60,000, it has reduced. When it reduces by 32,000, the balance we have is 28,000 pounds. And so what happens, again, the shop is going to increase by the same amount of 32,000. So we have another asset here called shop, and this is called, it increases by 32,000. And of course, our capital is still intact. When we add up both sides of the equation, both sides of the balance sheet, it balances 60,000 on both sides. So in our third transaction, it says that on 6th January 2020, Kisembo buys some goods from Managerial, 7,000, and agrees to pay for them sometime within the next 2 weeks. So he agrees to pay for them within the next 2 weeks. It means that this is a credit transaction. In other words, an asset has been purchased. In this case, the asset is stock because it buys some goods. So stock increases by 7,000. Stock has increased by 7,000. But under normal circumstances, we are expecting that we pay by cash. So it means that if it was by cash, cash would reduce by 7,000, but it is not the case this time around. What happens here this time around is that the Kisembo strikes a deal with Managerial, and the Kisembo is to pay the 7,000 after 2 weeks. So it means that Managerial now is a creditor to the business. So this is creditor Managerial. And creditor Managerial in this case is a liability to the business. Why is she a liability to the business? The business is supposed to pay her back, so it's a liability. So you can either call her account creditor Managerial, or you can simply say Managerial payable. Whichever. I'll just call it a payable because you're supposed to pay back, but this is a creditor, which is 7,000. So this creditor's account also increases by the same 7,000. So what happens to our balance sheet? Of course, again, our title is right there, the statement of financial position. It is at this point in time because we are analyzing a transaction at 6th. So we are analyzing everything from 6th January backwards. So as at this date, our statement of financial position is as follows. So looking at our assets, previously we had cash at bank, which is that, so that didn't change. We also had the shop, it did not change. So now we have stock. Then on the side of owner's equity, so on the side of liabilities, we have payables. The payables are worth 7,000. Then we also have owner's equity. And when we add up the two sides, again, the balance sheet always has to balance. So that is 3, the third transaction. Let's get to the fourth. So the fourth transaction is telling us that on 10th January 2020, so because it is 10th January, it means our balance sheet will be as at 10th January. That's the last date. On 10th January 2020, goods which cost 600 were sold to J. Brown for the same amount of money to be paid later. So again, what we are seeing here is assets are being sold, and these assets are being sold on credit. So what are the two transactions or the two items that have been affected? Of course, now here we have goods are being sold. So it means we have stock being sold out. It means stock is going to reduce. And what is going to be increased? Stock will reduce by 600 because we are looking at stock. The question says stock which costs 600. So stock which is worth 600 was sold off. However, it has been sold off to J. Brown for the same amount. So in other words, this stock cost us 600 and now it is being sold to J. Brown at 600. But J. Brown does not pay immediately. J. Brown is supposed to pay later. So it means this is a credit transaction, and so it means J. Brown becomes our debtor. And so if J. Brown becomes our debtor, now this is a receivable, which is an asset of 600. So how does this play out in our balance sheet? Again, we shall refer to our previous write-up to update our balance sheet. In our previous write-up, we have our assets as now these are the items that were in our previous balance sheet, that were in our previous write-up of the balance sheet. However, something has changed. we have sold off stock, and the stock we have sold off is worth 600. So it means that stock is supposed to reduce. This 7,000 is supposed to reduce by 600. And so it means that here we have 6,400. 6,400 is now our new stock, and now we have a new asset, a receivable, because we sold to J Brown, and J Brown is supposed to pay us later. So we have an asset, a receivable, or call him, you can write here debtor J Brown, but let me just say receivable because the word receivable is more relatable. We are expected to receive cash, and that is an asset. So receivable, the receivable is 600, and of course the liabilities remain the same. And of course, if you look at the two sides of this, you find that they are still balancing. So next transaction, we are having a sale of an asset for immediate payment. This is now we are selling something and we are getting cash immediately on 13th January 2020. So because it is 13th January 2020, it means that our balance sheet will be as at 13th January. So we are looking at transactions from 13th January backwards. But we are looking at how the business is standing as at this very point. So on 13th January 2020, goods which cost 400 were sold to Gilbert for the same amount. Again, here we are looking at the same scenario whereby goods are being sold without profit. And like I have promised, we shall look at the scenarios. How do we deal with transactions in the balance sheet where we are having goods where we sell with profit? We'll come to that later on when we are dealing with how to handle stock movements. So for now, we shall deal with this unrealistic scenario where you buy something at the same cost and then you sell it at the same price without making a profit. So, goods which cost 400 were sold to Gilbert. So goods which cost 400 were being sold to Gilbert for the same amount. The two items that were affected here, we have stock. Stock, because it was sold, definitely stock is going to reduce by 400. And now, of course, these goods were sold to Gilbert for the same amount. Gilbert paid for them immediately, so meaning that Gilbert pays money immediately, but he pays by check. So it means that here our cash in bank is going to increase. So these are the two items affected. Stock reduced because it was sold. When goods are sold, the stock you have reduces. And then we received cash, and that cash was in form of a check. So it means that our cash in the bank increased by 400. So how do we deal with this? We go ahead and fill in our balance sheet. Now our cash at bank, remember, increased by 400. So in our previous write-up of the balance sheet, we had our cash at bank as 28,000. So if our previous cash at bank was as 28,000, and now as a result of this new transaction, our cash increases by 400, it means now our new cash at bank is 28,400. Then of course the shop remains the same. Now our stock here reduced by 400 when we sold off our stock. It reduced by 400. In our previous write-up of the balance sheet, the amount of stock we had was worth 6,400. So it means as a result of this transaction, when you go ahead and sell off this stock, it's going to reduce further by 400. So it means that if before it was 6,400, it means that now our stock is 6,000. And of course, with that, our receivables still stand at 600. Again, our balance sheet still balances. So let's look at our last transaction. So in our last transaction, there is payment of liability. That is on January 15th, 2020, Kisembo pays a check of 3,000 in part payment for the amount owing. Now, what was the amount owing? The amount owing, we are talking about the payables here, the people who are that we are meant to pay. Kisembo pays in part. So what are the two items that are affected? Number one, when we pay 3,000 by check, it means that our cash in bank is going to reduce because we are using a check to pay. So it means cash in bank is going to reduce. It's going to reduce by 3,000. So it shall reduce by 3,000. Then, of course, also our payment, we are paying to the amounts owing. So it means that our payables are also going to reduce. In other words, the money we owe to our creditors is going to reduce. Well, how much was it originally? From our previous write-up, our payables were originally 7,000. And now, when we pay 3,000, our payables are going to reduce also by 3,000. When they reduce by 3,000, of course, here 7,000 minus 3,000, we remain with payables as 4,000. So our balance sheet now looks like this, and our updated balance sheet now looks like this. Remember, we paid this amount of money using cash in the bank. Because we used cash in the bank, it means that this amount of money in our previous write-up of the balance sheet, this is going to reduce also by 3,000. So it's 28 minus 3,000 to give us the new amount of money we are remaining with in our bank as like I said, for liabilities, our payables reduce from 7,000 to 4,000 because the 3,000 was paid by check. Then owner's equity remains the same, it's untampered with. So at a glance, that is how our final balance sheet looks like. From the transactions we have covered, you can see that at all times, assets are always equal to liabilities and capital. You have also been able to witness the fact that every transaction affects two items. The balance sheet has been presented using the T format. However, the balance sheet can also be presented in a columnar format, and also it can be presented with more details like current assets, current liabilities, and so on. The purpose of this session was to simply introduce the balance sheet. In a later session, we shall explore the balance sheet, or call it the statement of financial position, in deeper detail. Make sure to check out other videos on the channel, and as always guys, thank you very much for watching. My name is Arnold Rangakuramia, and I'll see you in the next session. Take care.